Next one up here, investors need to be cautious about buying stocks amid real recession risk.
Reaction to PPI, what it means for rate cuts, alongside tomorrow's consumer price inflation data. Joining us now, Morgan Stanley Senior Portfolio Manager Jim LeCamp. Are you telling your clients to buy in the wake of what we got last week, Jim?
So look, we may have put a low in last week, and I think it's entirely possible. But historically, whenever you do set a low like that after a 10% correction, you retest that low. And let's not forget that August and September are historically our worst 2 months of the year in the market, and we're still in fairly early in that time frame. So I think investors need to be cautious about willy-nilly going ahead and thinking there's a green light and to be aggressive and taking too much risk. Let's also not forget that there's a real risk of recession here. One of the reasons that we might be seeing prices ameliorate or the inflation rate ameliorate is because consumers are tapped out. We've seen delinquencies go up. We've seen foreclosures go up. We've seen bankruptcies go up. So there's some real risk in the market. Do I think we set a low in last Monday? I think very possibly we did. But even if we did, I think it's probable that we're going to retest. That happens about 2/3 of the time.
So how do you prepare for the recession, even if that isn't the base case?
Yeah, I think investors need to be aware that recessions are not good for stocks. Most bear markets occur during recessions. So I think there's a real risk of it when you look at the employment rate, when you look at the kinds of jobs that we've been adding over the last year, mostly part-time jobs. We've seen real softness in full-time jobs, and we've seen real softness in also the consumer's ability to absorb where prices are. Even if the inflation rate isn't going up as much anymore, prices still aren't coming down. So prices are still an issue for consumers. And consumers are also going to have a hard time buying houses in here. Yes, the mortgage rates might come down a little bit, but prices are still very high. Home affordability is still very high. And so it's a tough environment. And I think investors need to be aware that the market may be more volatile. If we do enter a recession, it's very likely we would have a bear market next year. So I think we need to be careful about that.
Jim, I wonder how your view kind of...
What he says there is fair, very fair, right? That's all potential. But on the flip side, oh man, so many different things can happen, right? We've been kind of waiting for the big recession. When we say the big recession, we're talking about the one where we see a big unemployment cycle, right? Unemployment rate goes to 6, 8, 10%. That's what we're talking about. And we've kind of been waiting around for this, it seems like, for the last few years. And so maybe we do get it next year, right? Maybe it actually happens. Or maybe it doesn't. What happens if the consumer gets in even a better place next year than they were this year or the year before, certainly, right? Because they're not being hit by inflation. They keep jobs. Wages stay in a good place and real wages go up. And what if the consumer bounces back hard next year? I think that's something that needs to be considered as well. So, you know, there's two sides to the story. And honestly, no one knows which side is the right side as of right now. But you got to consider both.
With the Morgan Stanley house view, which has been pretty dovish for a while, knowing that weaker prints were coming, and I would argue fairly constructive, looking for multiple cuts this year.
Yeah, I think we're going to have multiple cuts. Probably not on the as hawkish in terms of how many times they're going, or dovish in terms of how many times they're going to cut vis-a-vis the Morgan Stanley. I think we probably have probably 3/4 total of an interest rate cut. So maybe a quarter in September, quarter in November, quarter in December. The Fed has to be careful here. If you recall, if you look back to the late 70s, when we were dealing with inflation like we are today, Volcker stopped raising rates and actually cut rates during an election year. And unfortunately, that was not a good move. Inflation looked like it was improving. He felt good about cutting, but the next thing you knew, inflation reared its ugly head like a hydra. And the next thing you knew, Ronald Reagan, a newly elected Ronald Reagan, had to deal with inflation for the next 2 years. We didn't see inflation top for 2 years after that.
Yeah. But you got to consider the risk of the other side. You stay too high for too long. Decent probability you end up in that big recession with a big unemployment cycle, right? So It's like which is more severe, and then you have to come in, and the Fed's gonna have to load their balance sheet again. I mean, that's a whole mess, right?
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area.
Anyways, guys, next up here, put to call ratio. So put to call ratio, this is the most important, or at least one of the most important things you can pay attention to in the stock market right now, in my personal opinion. And the put to call ratio is up again here today. Now, the reason this is so important is it shows you how many people are actively buying put options out there versus call options. And usually there should always be a lot more people buying call options than put options because the market usually goes up, right? So here we are, we're still remaining pretty elevated on the put to call ratio. People are still looking for protection in regards to their portfolios. What happened last Monday really freaked a lot of people out. And it made a lot of people all of a sudden say, you know what, I got to hedge up my portfolio. I got to look for puts out there, right? And keep in mind, if you're over 0.8, you're in high ranges. If you go above 1, you're in kind of panic time. And so every once in a while, there'll be some sort of short-term panic. Like, for instance, Monday, we went to like 1.05 on the put-to-call ratio. It means more people were buying puts and calls. Those sorts of time periods, people are like in panic mode. But 0.8 is still pretty high here. It reminds me similar. Do you guys remember during the beginning stages of Rona, there was a toilet paper shortage? Like, wasn't that something? Like, there's so much happened during that whole Rona time. Like, I feel like sometimes we just forget about all the crap that happened, right? No pun intended. But remember, there was a toilet paper shortage. And it's because all of a sudden Rona happened, everybody started freaking out, and they all ran to the store to get as much toilet paper as possible. And stores were trying to limit to 1 toilet paper per person. And I mean, it was incredible. Like, something you never thought would ever run out in a store was running out. Like, toilet paper shelves were completely empty. People were panicking, and just, it's human behavior, right? And the same exact thing happens in the stock market. All of a sudden people panic, and what do they look for? They start looking for protection. They start getting into puts, and usually you're too late in regards to that situation, right? It's like the person that, I mean, you got to be ahead of this stuff. You got to be ahead of this stuff. You want to look for hedges when no one's looking for hedges, because that's usually when you're going to get hit by something, right? Now, the interesting thing, you look at the Russell here. Russell struggled today. It was down almost 1%, right? Still struggling. Year to date, the Russell's up 2%. 2% for the year? Tom Lee, where's our 50% gain for the Russell stocks, man? Come on. Remember Tom Lee going in this year? He's talking about small caps, 40, 50, 60% rise. I'm looking for those babies, man. Come on. When's this Russell going to get rolling? We're ready to have some fun in this market, right? But the Russell's still struggling. Now, with that being said, just because the Russell's struggling doesn't mean there aren't opportunities or places to make money in small cap stocks. For instance, look at the Planet. Planet up another bunch today, right? Stock's up like 50% plus just in the past 5 trading days. I wouldn't be surprised if that stock's $1 plus after next quarter. And the reason being is the Planet is all of a sudden now growing their revenues again substantially. Their profitability is getting better. Their margins are getting better. So the whole story in regards to Planet is getting better and better and better for the first time in years. I mean, it's literally been years. It was just like years of the Planet. Everything was just getting worse. Revenue, margins, profitability, everything. And now we just started the inflection to the other side of things are going to start getting better. And that's honestly going to continue regardless of the economy, regardless of Apple taking their 30% cut in the end, right? You look at somebody like Honest. I mean, this stock's up 165% in the past year, despite the Russell not doing a dang thing, right? And so the honest company, a very special opportunity there. They have their revenues going up more substantially than anybody anticipated. The margins have increased way faster than anybody anticipated. The profitability's gotten way better, way faster than anybody anticipated. So it's a freak situation in this market, even despite the weak consumer and all those sorts of things. The company's in massive turnaround mode, and they're executing on the highest level I've seen any company really execute a turnaround since Elf. Just to be quite frank, it's unbelievable, right? Look at a stock like Revolve, another small cap stock. This one's e-commerce play, clothing related. Stock's up 30% plus this year. 30% plus, despite the Russell being up, 2% this year? And so just keep in mind, even if the indexes aren't going up at a particular time, there's money to be made from the long side. There's money to be made from the long side, right? Because you're always going to have a certain amount of money coming out of stocks that are the losers, right? The bums of the stock market. Intel, right? Perfect example of a bum stock. Look at how much that stock sold off. People want to sell that stock. So then, where's money move? Well, it can move a lot of different places, but a lot of times it's going to move into positions that people feel much more confident about in the market, right? And that's just one example of a long list of stocks in the market. The only time really everything gets hammered from a long side is if you have a massive stock market crash. That's really, and that comes, every 5 to 10 years? In those very freak situations, once every 5 to 10 years, that's a one rare situation where you can't make money from the long side. It's just everything's getting hammered. Doesn't matter what you own. Growth stocks, value stocks, dividend stocks, it all goes down, right? But it very rarely happens. And so you got to always keep in mind in the stock market, most years, even if a specific index doesn't go up, there's money to be made. If the S&P 500 was only up 2% this year, there would be plenty of stocks in the S&P 500 doing absolutely tremendous. And you look at the Russell, up 2%, and there's plenty of small cap stocks that have performed 20%, 30%, 40%, 50% gains this year, right? And so that is some food for thought in regards to that. There's always money to be made in the market, regardless of what's going on, right? And specifically from the long side. Other than a crash, a full-blown crash, that's a little different, right? Speaking about crashes, on Friday's video, I spoke about Elf stock, right? I spoke about other stocks in that video and opportunities and things like that, right? But at the front of that video, I spoke extensively about Elf, the earnings, what I think is going to happen with the stock price, all those sorts of things, right? And that one is struggling right now in regards to stock price. This is a fun part of growth stock investing, right? 1,800% gain, like that's the fun part. This part recently in regards to Elf, this is a part that sucks. This is the issue with growth stocks, right? The stock down another 10% here today. That was after Friday. It was down, how much was it down Friday? 14 or 15% or something like that, right? So just the stock's getting absolutely hammered right now. Elf can't catch a break, right? In regards to stock price goes. And that's the big risk that you always have to account for when it comes to these growth stocks is, man, are they a lot of fun if they're just smashing numbers left and right. But as soon as, somebody doesn't like anything, and those Elf earnings were phenomenal. I went through it on Friday's video. If you want to watch that video and go in depth on everything, you can. But if there's just one little thing that's off, this growth rate over here, this margin over here, it's a reason to sell the stock off huge when you trade at very rich forward Ps, 2-year forward Ps. That's why I speak about valuations all the time on the channel. Not enough people speak about valuations. They pay attention to valuations. It's so important. It's so important for the risk-reward profile. And it can be the difference between you making 1,800% on a stock versus losing 40% on a stock. Like, a lot of it comes down to where you get in at, where you position at, right? This is so important, so important. Now, inflation is the next sort of subject, right? Because everybody's paying attention to what happens with inflation here, where's the Fed moving. Let's be very crystal clear. Factually, inflation is dead. Factually, inflation is dead. And inflation is dead by looking at a few different things. And meaning the way prices are going up, it's done. So the reason being is you look at inflation over the past year. This is inflation. This is looking at commodities. Commodities up 0.1%. 0.1% in the past year, which means inflation is done. Like inflation is dead. That's incredible that commodities can't even go up in this situation. And remember, what is everything in the world made of? Commodities. And so if commodities aren't going up anymore at this point in time, right, inflation is really done. And that's even despite us having some sort of major recession, right? Unemployment's still in the 4s right now. You got to keep in mind, if we were to have some sort of major recession where, let's say, unemployment rate went to 8%, 10% or something like that, don't be surprised if you see oil at $60 or $50 in that situation, right? Which would then actually cause the GSG here, which everybody should have on your watch list, GSG, that could potentially cause this to go negative, right? Never mind if you have gold and silver go down in that sort of situation, like this could literally go negative on a year-over-year basis, which means you not only would you not have inflation in the economy, you'd actually have deflation, which is a very rare phenomenon you ever have in the stock market. If we look at trueflation numbers, which I trust a lot more than the government numbers, I think trueflation numbers are way better than the government numbers. That's my personal opinion on that. Trueflation has us at 1.5%, which is significantly below the Fed's 2% number that they want us at, right? Which means inflation is dead right now. Absolutely dead. So the moral of the story is the dragon has been slayed. The dragon's been slayed. In the dragon that was inflation, it's done. Its head's been chopped off. It's away. And it's away for years now. Like, the chances that dragon comes back alive in the next few years are very rare. Very low probabilities. The chances that dragon comes back, 5, 10, 20, 30 years from now, there's a pretty high probability of that long term, right? But for the short term, that dragon is done. Now at this point in time, the dragon has officially been slayed. There's no debate you can take to the other side to really say inflation hasn't been destroyed. It's been destroyed now at this point in time, which leads us to where does the Fed take interest rates from here? Now, right now we're at about 5.5% Fed funds rate, right? In an ideal situation over this next 12 months, so over this next year, so let's fast forward to August 2025, an ideal situation is the Fed goes from where they're at right now, about 5.5% Fed funds rate, to about 2.5% Fed funds rate over this next 12 months. That would mean we had an orderly economy. We kept unemployment under 5%. There was no shock and awe in regards to the banking system or anything like that. This would be very good. Very good. If we can have that, if we can a year from now be looking at a Fed funds rate 2.5, which would be probably slightly above CPI at that particular time, that's ideal, man. That is a perfect scenario. That means the Fed was able to orderly kind of lower rates, maybe 25 basis points at a time, 50 basis points at a time, something like that, right? Now, a disaster, a complete disaster, is a situation where we go from where we're at right now, 5.5, to let's imagine we're a year into the future, so it's August 2025, right? And the Fed funds rate's around 0 or under 1%. That would be a disaster. That means we had some sort of crash in the economy, probably a crash in the stock market as well. That means things got very ugly and the Fed had a panic. They had a panic cut. No different than they panic raised in 2023, right? From basically the middle of 2023 through the beginning of 2020, or excuse me, that was actually 2022. From the middle of 2022 through the beginning of 2023, right? The Fed had a panic raise rates. They were raising rates at 75 basis points at a time. They were panic raising, right? And so if we go into a situation where they panic cut, that means the economy got devastated, the market got devastated. That would not be an ideal situation. So this is, if you want to hope for something, hope for around a 2.5%. We can call it 2.5 to 3% Fed funds rate a year from now, because that means we had an orderly lower. Now, in terms of, probably not a lot of people look at the Fed balance sheet and what's going on there. Total assets of the Federal Reserve, it has dropped over $1 trillion. Over $1 trillion has been reduced over the past 12 months. We were, if we go back a year ago, we were at over $8.2 trillion of assets on the Federal Reserve's balance sheet. We're now under $7.2 trillion here. So that's phenomenal. My guess is we're going to probably end this year somewhere around $6.5 trillion to maybe $6.7 trillion in regards to assets on the Federal Reserve's balance sheet, assuming they don't freak out here at the end of the year and have to, start purchasing assets or something like that, right? Now, I do think there's a decent probability that the numbers could reverse and go back up in 2025, and that's if we get some sort of situation where we do have a big recession that eventually pops out, right? The Fed would start to say, oh, we got to reverse course here. We got to stop reducing the balance sheet and we got to actually start adding the balance sheet. So that's always a potential that's out there. There's no guarantee. I would call it like a 50-50 probability right now. But you could see something like this, right? You could see this balance sheet continue to shrink down to, around 6.5 trillion or so. And then all of a sudden we do a big U-turn and, right back up. Now, in regards to the next time the Fed's going to add to this balance sheet, I think we're going to 10 trillion plus. I really do. I think we're going to $10 trillion plus on the Fed balance sheet in the next go round. It's going to be a pretty substantial one. That's my personal opinion in regards to that. But I like that the Fed's been able to reduce their balance sheet in this situation. But we'll see how much longer it lasts. My guess is it lasts probably another, I would say at least 3 more months, but probably more to 6 to 9 months, and then they might have to flatten things out in reverse course and do a U-turn there. Okay. Now, do keep this in mind. I do think this is a good reference, because the balance sheet for the Fed, the assets for the Fed was under $1 trillion before the great financial crisis. That's a little food for thought there. It's hard to even think under $1 trillion because now it's just so insane, right? But literally it's under $1 trillion. Obviously, we got hit by the great financial crisis, and that really changed the trajectory of the Fed's balance sheet forever, right? And now, anytime anything happens, the Fed is looked at as like, you guys got to come in, and you got to come save the day, right? And that's honestly the way it will always be from here on out, right? They really, in that situation, the Fed really got put into more of a controlling position than ever before. And it's kind of sad because now you listen to all these Wall Streeters, they're obsessed with the Fed all the time. All they can focus on is the Fed. And it's not nearly as much of a free markets anymore now at this point in time. It's not as much as about whose earnings or what. It's more about what the Fed's doing. And a lot of these Wall Streeters they'll let their buying and selling decisions be dictated by what the Fed's going to do or what they might do. And it's kind of sad, in my opinion, because it should be, what are the companies reporting? What are the companies doing for numbers, right? That should really take the highest level of importance. But nowadays, a lot of these Wall Streeters, and I understand it, like the Fed became so much more powerful after the GFC, and it's remained that to this day, and it's going to remain that. I don't think you can back out of that now at this point in time. Once you go down that rabbit hole, it's there forever, right?